In New York, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, Softbank calls in the banks for what is likely to be the largest IPO ever. But will the mobile operator be spooked by the latest market rout? Plus, US authorities open an investigation into the Broadcom CA Technologies deal. They're asking whether the companies were the target of a stock manipulation scheme. And Alphabet shareholders hit back over the Google Plus security flaw. They're upset the company didn't reveal the issue sooner, and they're suing. But first, to our top story. US stocks gave back some gains Friday following a strong early rally driven by technology shares amid hopes of easing trade tensions with China. The tech-heavy Nasdaq 100 index rose the most since May at one point. However, tech giants Facebook, Apple, Amazon, Netflix, Microsoft, and Alphabet have collectively lost $329 billion of stock market value since the beginning of this month. For more, I want to bring in Bloomberg Opinion's Shira Ovide to put this in perspective, really, because the size and the extent of the sell-off, what really got the market so spooked? Was it really, when it comes to tech, the China situation rather than the rate situation?
I mean, I think you can kind of pick your poison, right? That it's the same issues that we've seen infect the rest of the U.S. stock market. Worries about interest rates, worries about stretched stock valuations, particularly for these growth-dependent kinds of tech companies like Netflix, like Amazon. And then we've seen in the chip sector, the tariff worries are really where that's started to be felt. And the semiconductor stocks really have all sold off this month.
And that, of course, linked to the Bloomberg Business Week story about concerns about hardware hacking, too. Let's spin it forward, because come Tuesday, we start to get a bit more insight into the strength of these businesses, particularly one very hyper-growth company being Netflix.
Yeah, I think Netflix is going to be really interesting to watch when they report earnings on Tuesday. We saw the last quarter, there were some hiccups in subscriber growth, and the shares sold off very sharply. And now, earnings outlook is going to be even more important given the anxiety that we've seen about all of these factors, including tech stock valuations. So I think that's going to be a really interesting one to set the tone for the rest of the tech earnings season.
It was interesting today. We got a window into what's happening in the banking sector. JP Morgan, Wells Fargo, for example, Citi coming out with numbers. And even though they beat in many marks, they still sold, well, there was still caution on their stock trading. They couldn't hold on to their gains because of seemingly comments coming from executives. So it's going to be really important to listen to the calls as well as just look at the numbers, right?
I think that's right. I mean, people are looking for any excuse to be anxious right now. That just seems to be the market sentiment that we're in, at least today. We'll see what happens next week. And so you're right, that tone and caution or optimism are going to be really important kinds of things to listen for.
Also, there's still ongoing concerns about certain companies' business models, and they're once again taking a hit not only from the nervousness surrounding trade, but also regulatory issues. I mean, today again we hear about Facebook and indeed Alphabet, Google being sued on their Google Plus issues.
Yeah, it's been a phenomenon that we've really seen the last couple of years, is this regulatory overhang, particularly on Google and Facebook, but not only those companies, and it's inescapable. It seems like this is going to be basically the cost of doing business for these big tech companies, is just these fears that regulatory pressures are really going to pinch their profits or pinch their growth. And right now it's all theoretical, but we'll see what happens.
Well, it's not been theoretical in their share price moves. I think it was the worst day for the so-called FANG index since its existence ever earlier this week. We thank you, Shira Ovide, for putting it all in perspective, of course, from Bloomberg Opinion. Now, another story we're watching. Bloomberg has learned that Softbank has picked banks, including Goldman Sachs and Nomura, as lead underwriters for what's likely to be the largest IPO ever. Softbank's Japanese wireless business plans to sell about $27 billion worth of shares. Now, the mobile operator begins marketing the sale next month. Shares could be listed on the Tokyo Stock Exchange as soon as December the 19th. Here to discuss is Technalysis Research President, friend of the show, Bob O'Donnell, and also with us, Bloomberg's Elizabeth Fournier. Thank you very much indeed for joining us, guys. Elizabeth, start off with you. Big deal. Banks finally getting named. Who are the big winners here?
So there's the three big names we've got here are Goldman, Nomura and Deutsche Bank. So if you think about it, that's one from each of the sort of big jurisdictions that we're thinking about. You've got the local bank there, Nomura, going to appeal to Japanese investors, which what we're hearing is they're likely to be the biggest chunk of people. You've got Goldman covering, the US, but also internationally. Then you've got Deutsche there appealing to European investors.
Interesting that they're going so wholeheartedly global. Do they just have to by the sheer size and scale of it? I mean, you usually hear of companies being worth $27 billion, not actually listing that many shares all in one go.
Yeah, I mean, we're talking about a third of the company here, so we could be looking at a valuation somewhere towards 90 billion. So by its definition, it's global. I mean, if you think back to Alibaba in 2014, that was the last big share sale of this size we saw, and that was 25. So we're going even further than that.
Bob, what do you make of the fact that today of all days is when we hear the banks are being named after what has been one turbulent week?
Well, it is very interesting, Caroline. I mean, I'm sure that this was probably in the works for some time, and it may just be coincidental in terms of the timing. But when we think about why this one is so important, this is all really going to be about 5G and Japan and the 2020 Olympics. You don't tend to think of those things, but Japan is very eager to reestablish themselves globally as a major player. Of course, Masayoshi Son is a favored son there in Japan. A lot of interest in seeing what he can do, and this telecom development in 2019 in particular is going to be the launch of 5G. And there's a lot of focus on making that not just faster smartphones and things like that, but enabling completely new type of capabilities, things like broadcasting over 5G. And again, that ties into the whole 2020 Olympics story. So I think all of those, the announcement happened to be a weird week because of all the other issues, and I think Softbank does have some concerns we have to think about from the investments they've received from the Saudis into the Vision Fund. But fundamentally, I think it's going to be very interesting to watch. I think it's going to be a big one. And in some ways, it's sort of a statement or a referendum on 5G and how the world sees 5G.
Bob, remind us of also the Vision Fund and its link here, because it's a $100 billion fund, biggest private equity fund really out there, or venture capital fund out there. They're raising money, they're spinning off their telecom arm to be able to raise more cash for further investment on top of that.
Well, I mean, if you look at what Masayoshi Son has been doing, I mean, he's compiling a huge group of investments between the things he's done with Uber and other companies around the world. WeWork, they're talking about making an additional major investment in. So, I mean, this is a gentleman with a real vision. He always talks about the 100 and 300-year plans. I mean, he's thinking way ahead in terms of what he wants to be able to do. He's bought chip companies or IP companies like ARM. They have a big event next week in San Jose where they're going to be unveiling a bunch of new things. So, I mean, it's very interesting to think about what he's trying to do is compile a huge set of complementary companies and technologies together.
Elizabeth, I want to go back to the overall health of the IPO scene at the moment, though, as well, because yes, we've got one show of strength coming from Japan, but when we looked at China, Tencent, of course, have been in the eye of the storm, and they've backed away from a certain IPO, or at least put it on pause. That's right.
It's been a very sort of turbulent 24 hours for IPOs. When you think about the first sort of places that you see the effect of a market rout, it's often in the IPO market. There were a couple that were pulled in Europe yesterday. Soné and LeasePlan both said that they were putting aside their listings. And then what we're hearing with the Tencent Music is that it's just being delayed a little bit. They're not sort of put everything off, but they've been sort of pushed back until things look a little bit more stable. It
was interesting that we got a rather successful one coming out of San Francisco today, though. They managed to stick to their guns, and Anaplan actually manages to have a successful debut.
Yeah, it was a huge debut. I think the shares are still up 30-something%, and it follows on the heels of Elastic last week, which had a killer first day. So it shows that there are still a few exceptions that can kind of get out there despite the markets.
Yeah, Bob, interesting that software company did so well. What does it feel like on the ground in San Francisco when you're looking at the market turbulence? How have companies, investors, and analysts and voyeurs such as yourself really assessed this particular route?
Well, look, as Shira mentioned in her opening comments, it's all about sort of the feel of the market right now, and how people are feeling is a little nervous when we think about not only the tariffs, but the regulatory environment for tech. Those are big concerns. They seem to be much bigger concerns for larger tech companies and sort of more consumer friendly and aware. You're seeing these smaller, more enterprise focused companies being able to pull off IPOs, and I think we'll see that continue because they're smaller names, not as many people are watching them, tends to be a lot less controversial in terms of what they're doing. And so I think you're going to continue to see that. It's the bigger ones that are at issue. And the Tencent one, obviously, I think it's going to be fine, but there is that underlying question of is there a challenge going on in China? And is this the beginning of a potential challenge in China for tech IPOs because of the fact that a lot of these companies are highly leveraged? There's been some crackdowns there in terms of China as well. And of course, what is the influence of the trade war in the Chinese domestic market? And how does that influence Chinese companies? So I think there is perhaps a lingering question about that. But fundamentally, obviously, it's a huge business. And I think they'll do probably pretty well when it does go IPO.
We thank you, of course, for all your analysis from Technalysis Research, Bob O'Donnell, sticking with us, and we thank Bloomberg's Elizabeth Fournier as well. Now, coming up, a journalist who criticized the Saudi government has gone missing, calling into questions Silicon Valley's ties to the kingdom. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the US on SiriusXM. This is Bloomberg. Now, the mysterious disappearance of a prominent Saudi government critic is causing attendees to drop out of the country's event that is being dubbed the Davos of the Desert. Now, Washington Post journalist Jamal Khashoggi vanished after entering the Saudi consulate in Istanbul on October 2nd. Turkish officials allege that he was murdered after entering the building. Saudi officials claim Khashoggi left the building unharmed. But the news has prompted high-profile exits from the three-day future investment initiative set to start in Riyadh in just a couple of weeks' time. So far, billionaire Richard Branson, Viacom CEO Bob Bakesh, and Uber CEO Dara Khosrowshahi are just some of those no longer attending. And remember that recently Saudi Crown Prince Mohammed bin Salman toured the US, actually meeting with prominent members of the tech elite like Mark Zuckerberg and even Jeff Bezos, who owns the paper the missing journalist writes for. So what is Silicon Valley's responsibility when it comes to dealing with regimes with poor human rights records, like Saudi Arabia? To answer that, I'd like to welcome Naomi Nix, who covers corporate influence in Washington, and still with us in San Francisco, Technalysis Research President Bob O'Donnell. Naomi, the reaction here as we start to see companies back off, is it the only way they can play it? We're still yet to hear from certain companies such as Jamie Dimon's JP Morgan.
Yes, there are some companies who haven't yet taken a public stand. And I think the actions to, no longer attend a conference are notable, but they're, much easier to do than to, say, sever relationships with investors who are based in the country. And so that was a quick, sort of easy step to take. Whether there will be more actions by some of these tech companies or more actions by tech companies who have yet to take a public stand is an open question.
Bob, we've got to remind ourselves that Uber took a decent chunk of change from the public investment fund that is run by Saudi Arabia, PIF, just a few years ago. And indeed, PIF has been really very active in other tech investments, particularly linked to the Vision Fund. What do you think it means for the tech ecosystem?
Well, look, I think it raises some serious questions. I mean, obviously, there was no awareness of these level of issues with Saudi Arabia back then. They've had human rights concerns, but this has really brought those issues to the fore. And I think it's going to, raise the kinds of head scratching and really moral dilemmas that these companies are going to have to deal with. And look, we're in an environment right now where the tech industry is so poorly looked upon by so many parts, not even of the world and within the U.S., I think it's a critical moment for them to make some bigger steps. I agree. This was we're not going to go to your conference now. Okay, fine. That's great, and that's an important step, but it's more of a symbolic step. The question is, can they move beyond the symbolism and make really substantive changes? And that's going to be a much harder question to answer, and of course, it's going to take much longer to determine because the impact could be extremely large, longer term. But I think you're going to see a lot of questions being raised. You're going to see a lot of discussions being had behind closed doors in terms of what should we do, what can we do. But I think in general, the tech industry needs to make these kind of big moves, particularly in the overall environment we're in politically as well as economically as well as regulatory and everything else.
Talking of the overall political situation, Naomi, how has Trump reacted? Because as we mentioned earlier, it wasn't long ago that the prince was touring the United States. And in fact, it was just last week that Prince was saying how much he loved working with President Trump.
Yeah, the Trump administration has been reluctant to take some of the stronger actions that some lawmakers on the Hill have asked for, whether that be sanctions or blocking arms sales to Saudi Arabia. The Trump administration has, in fact, formed a closer relationship with Saudi Arabia as it seeks to protect U.S. interests in Yemen and beyond. And so I think that gives tech companies a kind of cover, as long as lawmakers are focused on their attention on trying to convince Trump to go one way or another. They're not focused on asking tech companies to take bigger steps. What might happen, though, is we might see pressure internally from some of these tech companies to take action. Increasingly, tech companies are having to grapple with employees who are, signing petitions and pressuring their leadership to take political stands, whether, it's at Microsoft and their employees are trying to pressure them to sever a relationship with ICE, the immigration enforcement, or whether it's Google recently pulling out of a potential deal at the Pentagon, in part in response because employees, raised questions about whether Google should be working with the military. And so I think, whether those companies take those kinds of actions after those kinds of questions are being raised, is really something to be looking forward to.
Yeah, Bob, it's interesting that, of course, one of the key companies that's desperately trying to reinflate its brand and perception from the rest of the world as to how it treats its employees and indeed its staff and those outside the business is Uber. And it's notable that Dara Khosrowshahi, the CEO of Uber, has come out saying, the reasoning behind why he's not going to be attending the event, saying he's very troubled by the reports to date about Jamal Khashoggi. We are following the situation closely, and unless a substantially different set of facts emerges, I won't be attending the FII conference in Riyadh. Who do you think that more CEOs from technology will all have to take the steps that Dara Khosrowshahi has?
I think they are, and if you look at what Richard Branson said, he took it even further, right? He said, this raises serious questions about future investments. We're talking billions of dollars that, Virgin was going to be deploying in Saudi Arabia. And he raised the question of, all Western companies are going to have to think about how they interact with. That was a particularly strong statement. Now, we'll see if other companies are as courageous as that. But I do think it's important. And again, it's frankly a good opportunity for Uber to try and present a more positive image of the type of steps that it's taking. So I think it was a great statement for him to make, and I think will be interesting to see if he goes a little further, as we've seen with the statements from Richard Branson. Certainly
food for thought when it comes to Saudi Arabian relationships and indeed many other countries with questionable human rights histories. We thank you, Technalysis researchers Bob O'Donnell and Bloomberg's Naomi Nix there. Great to have your analysis. Now, we should note that Bloomberg will no longer serve as a media partner for the Future Investment Initiative either. Now, attack assessment, Facebook updates on September's hack. But how have the details changed? We discuss. And Bloomberg Technology, it's live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Now, a major hack of Facebook reported by the company 2 weeks ago affected 30 million users. That's not the 50 million originally feared. In a blog post, Facebook confirmed this slightly smaller number, but it also added that intimate information of about 14 million users was accessed. Now, that includes data like recent searches and location check-ins. Speaking on a call with reporters, Vice President for Product Management, that's Guy Rosen, explained that the company can't reveal the identity of the hackers.
We are cooperating with the FBI on this matter. The FBI is actively investigating and have asked us not to discuss who may be behind this attack.
Joining us with more details is Bloomberg Technology's Sarah Fryer in San Francisco. Sarah, how worrying is this? Yes, they've scaled back the overall number, but there's some intimate information they've clearly garnered.
There's almost a rule with disclosures of breaches that it's always worse than you think. Although there are fewer profiles affected than maybe Facebook originally feared, the kind of information that has been taken by these hackers, it's rather intimate. And the thing about this kind of hack, if somebody gets your password, if somebody gets your login information for something, you can change it. If somebody gets your personal life details, you're with that for the rest of your life. So the hackers, even if we don't see them immediately put this information into use, they could hold on to it for years and potentially do a very damaging hack down the line, knowing what they know about you.
Yeah, talk to us about the kind of details that they've got, because in particular, they've managed to focus on some 400,000 where they've got really up close and personal.
So those 400,000 accounts that they initially connected to served as a gateway to the rest of the 30 million that ultimately were affected. And of those 30 million, it goes sort of half and half. So like half of those people, they just got name and contact information, and with the other half, they got these intimate details like their search history, their information about who they're friends with, who they've had messages with. This is a little bit beyond what we would expect somebody to see if they were just looking at your profile. Especially the location check-in data, they know the last 10 places you checked in or were tagged in, which could be potentially a security issue for people. In those initial 400,000, it was even a little bit more intimate than that. The hacker could see their profile almost at the level that they could see if they were that person.
Now, trading Friday, we saw Facebook initially get a pop at the start of the market. We saw it up about 2 percentage points. It's now fallen back into negative territory. This clearly couldn't come at a worse time in terms of the overall valuation of the company.
Not just the overall valuation of the company, but the journey that Facebook has sort of been on this year to try to restore trust with its users. We had that Cambridge Analytica scandal in March, which revealed that personal profile information was shared with a third party without the consent of up to 85 million people. That led to all sorts of hearings, and they just sort of felt like they'd recovered from it in terms of the public discourse. And then this hack happens as they're trying to launch this device for people's homes to have them communicate with each other through this video chat portal. I mean, that's going to be very difficult to sell when people are worried about trusting Facebook with their data. So there are all sorts of risks to the company overall when something like this happens.
Sarah, are you expecting any sort of changes at the helm of Facebook, at the way that they've been reacting? Because they've also been criticized. You can understand when perhaps hacks occur that a company desperately tries to rectify the situation, but in many times they've been criticized just from the way that they've reacted from a communications point of view.
Well, one thing I will say about this vulnerability and the way that they've talked about it, it's night and day from the Cambridge Analytica scandal. When that happened, their mode was very defensive. They didn't put Zuckerberg out there or Sandberg out there to explain what happened. Yeah. In this case, they're being more forthright.
Sarah Fryer, always great to get your take on all of this as she covers Facebook for Bloomberg Technology. Thank you. Now, coming up, Broadcom has won over the European Union. The EU has approved the chipmaker's proposed takeover of CA Technologies. We'll bring you the latest next. This is Bloomberg. This is Bloomberg Technology. I'm Caroline Hyde in New York, in for Emily Chang. Now, Broadcom has won antitrust clearance from the European Commission for its proposed takeover of CA. That's according to an EC filing early Friday. Bloomberg has also learned that the US is investigating whether Broadcom and CA Technologies were in fact the victims of a stock manipulation scheme. The probe has to do with a memo circulating in Congress, giving the Pentagon's assessment of the security risks involved with Broadcom's planned purchase of CA. Broadcom says, well, the memo was fake. For more, I want to bring in Bloomberg's deal reporter Ed Hammond, who got the scoop. First of all, let's just talk about the European Commission. Was this expected? All free rein for them now to get the deal through?
Yes, it was expected. In fact, there's very little left in terms of real sort of regulatory clearances they need to do. I think they only need antitrust approval in Japan, which again is kind of a foregone conclusion. So this was expected, but as you say, it comes across or comes sort of along this backdrop of potential stock manipulation in both CA and Broadcom.
So perhaps no wonder we got a bit of a share market relief and a spike higher on the expected EU news. Let's dig into this memo. So what exactly happened? This memo goes live and everyone thinks initially it's real that they're being investigated.
Yeah, so to back up even further, Broadcom is a company that has been in the crosshairs of the US government before CFIUS blocked their last deal with Qualcomm, citing national security concerns. So there has always been this slight sense around them of like, are they really trusted by the government as a good actor in the tech space? Then we see this memo show up, which purports to be from the Department of Defense, saying we have all these concerns, and it doesn't look like a deal we want to see happen. Rand Paul cites some figures from the memo that were incorrect. Whether or not
he cite them? Because he's
in a conversation with Bloomberg, and what we don't know is whether or not he actually had the memo or whether he just by coincidence was sort of citing these same figures. Anyway, he said he wants a CFIUS review of this deal and he thinks there were problems with it. Then we find out that the DOJ and the SEC are both looking into whether or not there has actually been market manipulation, because they've seen the memo, they think the memo is a fake, and they think, therefore, that someone was trying to move the shares. There is, we should note, quite significant short interest in CA. I think about 8% of the float was actually out short. That said, on the other side, the spread on the deal is tiny. It's really, really tight spread.
They expect it to go through.
Which the market expects this one to go through. This isn't the same as Qualcomm. I mean, you could draw some comparisons because they're both tech, but it's a much smaller deal, much less critical to sort of, US infrastructure. And also, crucially, Qualcomm was the national champion that Trump and his administration had identified as they wanted Qualcomm to be the global leader in semiconductors. And they said, look, if we allow these companies to merge, that potentially gives China a leg up in the race to 5G. Not the same issue with CA.
Just briefly, does this stuff happen often, that these sorts of letters, these spoof letters go round? How often are they investigated?
The answer is no, that doesn't happen very often. And if it does happen, we don't get to see it because CFIUS is by its nature so very secretive. Interestingly, we are in an environment where it's starting to happen more. CFIUS has become much more muscular in its ability and its willingness to actually block deals coming into the US. We're seeing it outside the US as well. China is being much tighter in terms of what it will and won't allow through. We saw that recently when they blocked Qualcomm from their own deal with an XP. And in the EU, we've just seen new legislation come through, which makes it much harder for foreign investors to come in and do anything that's considered critical infrastructure investment acquisitions.
Geopolitics at play everywhere, it seems. Ed Hammond, great scoop. We thank you for joining us. Now, Alphabet shareholders are upset with the company over its handling of the security flaw found in Google+. Investors are suing the company, in fact, and CEO Larry Page, Google CEO Sundar Pichai, and Alphabet's Chief Financial Officer Ruth Porat claiming that they should have been warned when the flaw was discovered. Bloomberg Technology's Gerrit de Vink has more following the story and joins us from Toronto. Gerrit, talk to us about whether this was anticipated.
I think this was anticipated. You see these kinds of things all the time whenever you have a data breach or any other time when you can make an argument that a company really should have talked to the market, talked to their investors about something that they did, and then they didn't. And in this case, that's exactly what happened. Back in March, Google found that they had a potential, what they called a software bug that could have exposed the data, hundreds of thousands of their users, to who knows who. And they decided, though, that they had no proof that that happened, therefore it wasn't, in their opinion, a material event, and decided not to talk about it until their hand was forced by some reporting earlier this week.
Yeah, so that's the important element here, isn't it? That it was a glitch, but it wasn't actually a data breach. Who, in fact, is out there? Who are the investors who are taking this move? And how worried would not only the company be, but the likes of Ruth Porat and Sundar Pichai and indeed Larry Page, who are mentioned in it?
There's law firms who sort of specialize in this kind of class action investor lawsuit. So whenever something like this happens, you have multiple law firms immediately trying to drum up some publicity, trying to reach out to anyone who might want to sign up, and then to get a certification of their class action lawsuit. I mean, that's not to say that this couldn't go forward. I think there's a very strong argument that Google really messed up here, that they were worried about the political ramifications. They saw what Facebook was dealing with, and they didn't want to have to deal with it themselves, and they didn't want to have to face the music for this glitch, potential breach, whatever you want to call it. And they held that information back, especially at a time when they were preaching transparency and saying that they were talking about things. And so I think there's a strong argument here. This is something obviously that would take a long time to play out through the courts. And at the end of the day, I mean, Google is a nearly $1 trillion company. I'm sure any, class action lawsuit would be a blip in their financials, not a big problem, nothing compared to the mega fines that the EU has been levying towards them, and that they've also been able to just sort of brush off of their back with their cash on hand. So at the end of the day, though, I think the important thing to take away here is that Google decided not to talk about this. They're now being called out for it, and it's just another example of a big tech company, not exactly getting it right in terms of what users, politicians, regulators want from them when it comes to transparency.
Interestingly, Google didn't, Alphabet, the parent company, didn't see much of a slide in the shares. They're off by about 6 percentage points after we got the news of this potential glitch. Why do you think there wasn't so much impact? Do you think the regulatory burden won't be so significant when against Google in this particular turn?
I mean, we're comparing that to what happened to Facebook, obviously, when the Cambridge Analytica scandal came out, which was a very significant hit to their stock that they actually, in the subsequent months were able to build up. They're down now again, but that's more for business reasons. I think a lot of the political fallout has already sort of been priced in and played out in this scenario. And although there's a lot of noise, people do not expect major, deep changes to the regulation. Even when you look at Europe and what happened with the privacy regulation there's a strong view that it actually helped entrench Google because they actually have the power to deal with those regulations while their smaller competitors are finding them a lot tougher. And so I think that the investor view is to sort of take a cautious view on a lot of this political noise. That said, just as a reporter, as someone who watches these companies very closely over the years, I think that this has gone on longer than I would have expected. I, kept saying, oh, this will, sort of blow over. People don't really care about privacy in such a serious way. But I do think that as you see the noise continue to ratchet up, it shows that people do want to talk about this. And as the midterm elections approach in the United States, both parties are, although they have lots to talk about, they are talking about Google. They are talking about tech. It is one of their sort of points that they're hitting home, that they're talking to their voters about. This is not going away for these companies.
The regulatory overhang continues. Bloomberg Technology's Garrett Vink, we thank you from Toronto. Now coming up, despite the crypto sell-off, some bulls remain steadfast on their commitment to Bitcoin. We'll hear from Draper Associates and DFJ Venture Capital's Tim Draper next. And streaming giant Netflix is set to report its quarterly earnings next week. Find out why it's poised to set the tone for tech earnings season when we return. This is Bloomberg. Draper Associates and DFJ Venture Capital founding partner Tim Draper remains bullish on Bitcoin. He told Bloomberg's Stephen Engel at the World Knowledge Forum in Seoul that he's standing by his calls for the cryptocurrency strength in the face of global market turmoil.
When things are tough, when there's political turmoil, Bitcoin does well because people say, gosh, I'm not so sure about my government, my fiefdom, my tribe, whatever it is, tied to some artificial geographic border. I might like this decentralized world, and I think that's going to be a really interesting time. I think our next 10, 15 years are going to be a major human transformation.
Well, we're seeing transformation in, cross-border trade flows right now. How is the trade war right now shaping up in your estimation as far as opportunity or, some risk?
It's played up as a trade war. I feel like it's a trade negotiation. They're trying to just figure it out. I know both countries know that they're much better off having open borders, and somehow there are a few things that they want to tweak in their trade. And I think those things are going to, I hope they'll solve themselves. I'm very concerned about the idea of these fiefdoms, China, the U.S., Russia, all getting more controlling over their people. Freedom equals prosperity. Freedom and honesty equal prosperity. And if a government is free and honest and open, that country will do very well. And if the leadership is controlling and they give special treatment to some people over others, it's not fair. Those countries sink economically.
So you still have a call for $250,000 on Bitcoin by 2022. What's going to be the catalyst for that?
Well,
how is that possible?
It's just a matter of over time, time, it takes a while for entrepreneurs and engineers to create all of the visions that we all have of this wonderful world where we have a decentralized cryptocurrency, and we're open, and the geographic borders have fallen and all that. Engineers take time to develop those products. So for you, once you are able to buy Starbucks coffee and McDonald's burgers with Bitcoin easily, suddenly you'll make this trade-off. Do I want a decentralized, frictionless, global currency that I can pull down anywhere, or do I want one that's tied to fiat and tied to a government that swings back and forth depending on their political will or the...
Is there over-regulation, though? I mean, we've seen China crack down on ICOs and also mining. South Korea here has cracked down on ICOs. Others are looking to making their areas an ICO hub. But again, there seems to be fear from regulators.
Yeah, I think the regulators are fearful, and they're spreading fear. What they're doing, they're regulating at their own peril. They're creating friction items toward progress. And when they do that, all the best entrepreneurs, all the great brains move out of the country. So they're losing all their young population. Anybody who wants to go start something, do something, of course those people are going to be using Bitcoin and all the associated technologies with Bitcoin to start their business. It makes perfect sense. So when China or South Korea say we're not going to allow Bitcoin here, all those entrepreneurs go somewhere else.
Well, North Korea, I think, is having a blockchain Bitcoin conference this week, and they're looking at doing or some sort of cryptocurrency.
You know, if North Korea were to open up and say, hey, like Japan did, Bitcoin's our national currency, all of a sudden you'll see all sorts of activity there. And 40 years from now, it might be the South Koreans that want to get together with the North rather than the other way around. Freedom builds prosperity. Freedom and open and fair environments build prosperity. And if you have a dictatorship and you're trying to control your country in some way or another, you're trying to over-regulate your people, they'll leave. Yeah. We can now leave.
Draper Associates and DFJ Venture Capital founding partner there, Tim Draper, speaking to Bloomberg's Stephen Engel at the World Knowledge Forum in Seoul. Now, earnings season is getting underway, and the first of the FANG stocks, that's Netflix, will release its numbers on Tuesday. The company is hoping to prove that last quarter's miss on subscriber growth was just a one-off. Here to discuss is Bloomberg Intelligence's U.S. Director of Research, Paul Sweeney. Paul, how are we gearing up for Tuesday?
Yeah, this is definitely a very anticipated earnings release for Netflix. It's always an event when Netflix releases earnings, given how the stock has performed over the years. But once again, investors will be focusing on the net subscriber add number. That is really the metric that investors focus on for this name, as opposed to EPS or even revenue. It's how many subscribers did they add globally. This quarter, they're looking for about 5 million. We think that is a number that they can hit and maybe even exceed. But that is the key number. And as you mentioned, last quarter, they missed on this very important metric, and the stock took a big hit on that news.
Took a beating, down 15% then. Right now, the stock's been taking a beating as well. We've seen the biggest slump since 2016 in some cases for this particular stock. Citi and some analysts are now seeing opportunity when it comes to Netflix. Is it from a valuation perspective as well as underlying growth drivers?
Well, it's tough to make a valuation call per se on this name. I think, when people look at this name, they kind of have to put their valuation hat aside a little bit and really think about the global market going forward, and the fact that consumers are spending more and more of their time consuming content in a streaming fashion as opposed to the traditional pay TV window like the cable service. And so in that regard, if you think that is a global business and has a long-term growth story on a global scale, then Netflix is the name. And the story for most bullish investors is, as long as they can continue to grow their subscriber base, they can continue to increase their investment in programming, which presumably will drive even more subscriber growth going forward. So that is why the subscriber growth remains really key for this story.
125 times future earnings is where it trades at the moment. How important is it that they can still entice people in while they hike prices as well?
Yeah, it's the company has proven that they have pricing power. They've raised prices several times over the last couple of years and has not impacted their subscriber growth. So when you take a look at this story, one of the concerns for investors is the fact that they're spending so much on programming. This year they will spend more than $8 billion on their P&L this year. That is up dramatically from last year, and the expectation is they will increase that spending next year. The problem is they don't have the free cash flow to support that, to fund that. In fact, the street consensus is for about a $3 billion free cash flow loss this year. So the company is financing this huge investment in programming in the debt market. Now, they can continue to do that as long as they continue to grow subscribers, improve profitability, and ultimately get the positive free cash flow so that this can become a self-supporting business.
See if the latest Ozark or Orange is the New Black will tempt them in. Bloomberg Intelligence's Paul Sweeney, we thank you live from Princeton. Now, still ahead, luxury retail has been fighting against a tide of trade tensions and equity sell-offs. But some retailers are looking to produce their own content in a bid to drive sales. That's in our Retail Interrupted series next. This is Bloomberg. Luxury retailers have much to contend with as the trade war deepens and competition for consumers' cash grows. Add in this week's global equity sell-off and, well, luxury goods companies are in the red on the year. Many are looking for new ways to engage with shoppers. And as part of our series on retail disruption, Bloomberg's Emma Chandra took a look at one retailer's drive to produce content to generate sales. She spoke with the luxury e-commerce site matchesfashion.com Chief Content Officer Kate Blythe.
So I think things have really changed in the retail landscape over the years. Before, customers would go into a store, they'd purchase their clothes, whatever they're buying, and then they would leave. And I think in order to really gain the trust and the loyalty and to have the customer come back for repeat purchases, you need to do something much more special than that. So we really started on the content journey about 6.5 years ago, and we really believe that the way in order to really engage with our customer and to keep them coming back time and time again was to produce content.
And so what sort of things are you producing?
So we want to create the ultimate lifestyle for our customer on every platform. So they shouldn't have to go anywhere else for their travel stories. They shouldn't have to go anywhere else for their fashion shoots, for inspiration on how to dress, for interviews with musicians, with people behind brands. We want to build out a content platform where they can come to us for everything that they want for a stylish life.
In the end, though, content must have a business purpose. It must also be about driving sales.
Sure, and it's about engagement. And we find that our customers who read our content are 24% more likely to make a purchase the same day than people who don't read our content. It is so powerful that people come to us for the quality and the different types of content than they would go to other platforms.
And you're happy with that conversion rate?
Yes, and I think we can do a lot more with it.
Now, Matches Fashion has also made another big move in recent weeks. It's opened a brand new physical space, 7,000 square foot, in the heart of London's swankiest district, quite frankly, in Mayfair. But Matches Fashion also gets 95% of its sales online. Why would you need to open a physical space if you're doing so well selling online?
We've always wanted to build an experience, and we always wanted to build a space where people could experience the online world that we've created. So it's not just a shopping space. Yes, you've got floors of private shopping, and you're going to have retail installations in there as well, an exclusive product. But we've also got a media hub. So we're going to be live streaming panel talks. We'll be doing podcasts with all the designers that come into the house. So the idea that we're actually making an experience for the customer and doing something quite special. We're trying to create a physical manifestation of the site.
So it's a content as well as a commerce hub?
It's exactly that.
And so what do your competitors think of this, the likes of Net-a-Porter, of Farfetch?
I think what we're doing is very different to what anyone else is doing. We are really creating a content space as well as a shopping space. And I think by being really experiential, anyone can walk into the space. We're producing exclusive content in an inclusive way.
Is there a difference between the way UK and European retailers are attacking the new way that customers want to shop compared to what's happening here in the US?
I think what we have done as a business is to always focus on innovation. So there's something that's so intrinsic to the business and the brand that we will take a risk. We want to try things that no one else has tried before, and we will be the trailblazers. And I think that's really exciting. And I think that a lot of people will look to us for those innovations, and then a lot of people will look at what they're they're doing and thinking how they can be more experiential, how they can produce more content in a different way.
And how does your new investment, or your new owners, private equity company Apex Partners, they've invested rumoured almost $1 billion in Matches Fashion. Does that kind of investment allow you to take more risks?
So they are brilliant partners of ours, and I think what that has done is it's just moved us into the next kind of level of business. There's so much potential for growth and so much potential for change and innovation within our business, and we want to keep pushing the envelope and doing things our way and doing things differently.
So what's the next iteration for the business?
I think at the moment we're just focusing on growth, and we're just focusing on being as innovative and challenging and disruptive as we can, but always in a very luxurious way.
MatchesFashion.com Chief Content Officer Kate Blythe speaking to Bloomberg's Emma Chandra there. And that does it for this edition of Bloomberg Technology. On Monday's show, Emily Chang will be live from the Wired 25 Summit. You don't want to miss that. I'm Caroline Hyde, and this is Bloomberg.